We get a slow start to the week, but key event risk looms ahead. Is it going to be a problem for stock markets? That's what we're going to dissect here on Macro Money. I'm Ilya Spivak, head of global macro here at Tasty Live. And not surprisingly, sure enough for those of you watching here, we are going to take a spotlight and shine it directly on U.S. CPI data, which is precisely the first bit of macro event risk here in front of us, and arguably the biggest for this week. Now, we're going to get some other notable points here as we go, but it is this report that is likely to set the stage for financial markets, and we're going to dissect what it may do and why. But first, let's take a look at how the markets performed last week, see if we can get a sense for the path of least resistance there. And of course, what we immediately see is a little bit of a rebound for stocks, 2.4% for the S&P, a more potent 3.6% for the NASDAQ. Yields nudge up a little bit. Of course, the previous week we see red all across the board, and that's in the wake of those very disappointing U.S. jobs figures. Last week, we got a little bit of a wobble on the S&P around disappointing U.S. ISM data. Interestingly enough, of course, that data coming to us alongside a parallel S&P global set basically tracking the exact same type of data, also service sector PMIs, and the market pointedly ignored those. But we can see that those sorts of things didn't really have staying power. And so we end up with a little bit of a rebound in yields, a little bit of a rebound in stocks, as we basically shrug off those figures and get back to what is essentially the starting line for the month on stock markets. In fact, we'll jump a little bit ahead here just to get a sense for what's going on and have a look at the S&P 500 here. This is the baseline September contract here, the ES contract for the S&P 500, and we can see here's where we started this month. And here's where we are now. We're essentially in the very same range where we started to idle here, just ahead of that high at 64.58.50 on the September contract. And we can see here, as we get ready to make this turn lower into this support at about 62.41, this band that's been holding us up since the beginning of July, what is it that we find? Here's the last Fed meeting that ultimately doesn't do anything. Here's the fade on those Meta and Microsoft earnings. We got the gap higher. That's where we got the record high. But we don't manage to make hay of it. In fact, we end the day lower once those numbers are subsumed. We also get this divergence with RSI, or you can pick your oscillator, but when you get higher highs on the price that don't get matched with higher highs on the oscillator, that just from an arithmetic perspective tells you momentum is fading. No rocket science there. RSI is just the ratio of closes up to closes down. And so if you're setting higher highs, but you're losing capacity to close up relative to down, this is third grade math now, momentum is ebbing. And maybe that's because we've settled into a sideways sort of a situation rather than a nakedly upward sloping one. That much is unclear, but we can see there's the jobs report. That's what gives us this hit back into the range. And then this little red bar there, that's those numbers on the service sector last week. Since then, we can see we've clawed back up and we're back into this decision point. Now, looking at some of these other assets last week, crude oil swinging lower, but not really going anywhere from the midpoint of its multi-month range. Gold a little bit higher, but again, at the top of its multi-month range, and in today's session, recoiling in the opposite direction. A little bit more life in currencies not named the US dollar after last week's very impressive dollar rally, despite the headwinds from that jobs data. We get a 1.1% rise in the euro. The yen is flat. Bitcoin, though, does manage a 3% gain. Now to the data, because the question from here, of course, seems to hinge on it. And the expectation is that headline inflation, the headline consumer price index, will rise to 2.8% year on year. That would be the highest since February. Likewise, for the core number, that's expected to rebound back to 3%. Again, the highest since February, so a 5-month high on both fronts. And of course, what matters most to markets from this perspective is what this will mean for Fed policy expectations, which we can see here give us 50 basis points in rate cuts for this year, 67 for next year. Now, that's at least 3 cuts and about a 68% chance, or at least 2 cuts and at least a 68% chance of a third for next year, and almost exactly 2 cuts, that extra 1 basis point we can chalk up to a rounding error for this year. So, how does that compare with the Fed's own outlook? Well, it's exactly in line with what we have on the menu for the Fed for this year. The median rate now, 4.4%. That's the midpoint between the 4.5 and 4.25 that are the bounds of the Fed's target range. And we're looking for a move from 4.4 to 3.9. That's 50 basis points. So the Fed is in line with what the markets have on the menu here. And that much seems to be relatively well anchored. In fact, if we look here, we can see basically since the beginning of the year, this is where we've been. The floor has been 50 basis points. We've flirted with as little as 25 basis points very briefly recently, but we're generally anchored right here. And when the Fed set this forecast back at the start of the year, which was right around here, we can see that we veered a little bit here and there, but we've generally remained in this area. The real movement and the real disparity, which seems to tell you where the market's head is and what it wants to see, is in the outlook for 2026. Because we can see that here we've increasingly opened up a wedge. And while the Fed only has 25 basis points from 3.9 to 3.6 for next year, that's a single cut only, the markets have this, as we just said, at least 2 with a high probability of 3. So clearly the markets want to see more rate cuts and think that 50 basis points now, only 50 basis points, amounts to dithering. And that the markets are going to want more, that the economy is going to need more, and that the Fed is ultimately going to give them more when it comes to next year. Now, if we look at where this type of thing starts to clash with the Fed's thinking, it isn't difficult to find. So here's the June breakdown, and we can see this looks refreshingly normal. The headline going up, the core going up, and most of it still in the service sector, where that's a tad bit warmer. But most inflation is still in the spot where the Fed would want to see it. Of course, the Fed has been reluctant to cut rates because it is worried that what these new tariffs will do, that the Trump administration has been rolling out since the beginning of the year, is create an inflationary shock, whereby you get essentially a consumption tax applied to imports. Now those imports have a higher sticker price. Consumers don't buy them. That slows down overall consumption, which then slows down the economy, and you get the unfavorable mix of weak growth with higher prices. And indeed, if you look at what is actually in these Fed forecasts from June, you get that sense. We see growth projections here revised lower, whereas inflation expectations are revised higher. So this is why the Fed ostensibly isn't cutting rates. At least that's the logic that Chair Powell and company have unfurled for us in recent months. And so it is here that June's numbers start to look a bit worrying. Take away this food and energy because, first of all, these contributions don't really meaningfully change for food and for energy. They change, but mostly just because a negative number becomes a smaller negative number. And in any case, the Fed doesn't really have much agency over these things. They're set in global markets. The Fed is more so focused on core. But this starts to paint a picture. And it seems small because, of course, most inflation is still buried on the services side. But when you look at the month-on-month changes in the contribution, this is where you start to get perhaps a bit of a concern. Almost all of the increase in core CPI looks like it comes from the goods side, whereas the services side is very soggy. So this 0.1 of a percentage point contribution to overall core CPI, this increase, it comes from the part of the structure here where tariff-based inflation would be. And perhaps it is early days yet. We'll see, of course. Last month we saw that PPI numbers were painting us a picture where we had a situation that was hardly supportive because there was evidence there that the tariff-based inflation is in fact here, but what we don't see is full pass-through because wholesalers at the front end of the curve are essentially eating that inflation, absorbing it into margins, and insulating markets downwind from that impact. So insulating consumers, insulating final stage wholesalers. But it is starting to appear, and the cracks are seemingly starting to show. So what this starts to suggest is that indeed the Fed's concerns have some credence here. And maybe if we get a hot number this go around, those concerns start to push away a September rate cut once again. Consider here the Fed's preferred way of looking at the dynamics in the story. This is 3-month and 6-month annualized CPI, both core and headline, which starts to show you what the problem is. So on the bottom here are the monthly changes in both headline and core, and we can see that with these changes running at about 0.25%, we're starting to see that these higher frequency indications are trending in the wrong direction. So you can see from May to June, the 3-month annualized goes up. Ditto for core. You can see that the 6-month rates have seemingly stopped falling, or almost, after this deceleration that we've seen since the beginning of the year. So it seems like if we were to get even slightly warmer numbers. In the case of core, we're looking for a 0.3% change this time, 0.2% for headline. Even if we were to get numbers roughly in line with forecasts, still, these dynamics would be going the wrong way for a second consecutive month. And that's not the kind of thing that the Fed is likely to take with a grain of salt. That's the kind of thing that may start to tell the markets, well, the Fed is seeing exactly the kind of inflation it doesn't want to see. It isn't going to jump the gun. Now, as it stands, the likelihood of a rate cut in the September meeting is still commanding, 86.4% against expectations of no change at 13.6%. And we're almost fully discounted for a second cut either in October or December. Markets aren't quite sure which one it is. It's about a 50-50 shot on either. But they do expect that at one of those meetings, there will be another cut. Interestingly, in the wake of that data on U.S. jobs, this sell-off right here, the case for a September cut fell off the board and really has only rebuilt once we've recovered from these losses. But it was very clear that what the markets didn't want to see was that rate cut go away. And so when we start to look at this in context, we say, okay, well, if the jobs data put the rate cut back, but ahead of it, it wasn't there, or at least the markets got to a less than even chance that it would arrive. That's after this hawkish Fed announcement. What might happen here were the numbers a little bit warmer versus a little bit cooler than expected. Well, we can see that on the cooler side of things, stocks do not want a growth scare. Perhaps not even the increase in rate cut odds then is necessarily supportive if the numbers are bad enough. But that seems like an edge case. The likelier scenario is we get something closer to forecasts or something on the warm side, at least if the recent surprises on inflation data elsewhere hold. Certainly the ISM numbers that we saw last week still pointed to very potent inflationary forces, in particular in the service sector, which is, of course, the largest component of the economy. The price growth component there gave us the highest inflation reading that we'd seen in quite a long time. As a matter of fact, the highest since October 2022. Now, we did get a little bit of a slowdown in service sector price growth, but we're still very, very elevated there relative to history. And so there does seem to be quite a bit of inflation that's still in the hopper. And if the markets get the sense that that there's enough of it here for the Fed to be concerned, well, then they probably won't love it. And so this is where things may well get interesting. It could be that while we're back at these highs, the top of this range ends up holding. It's the flip side for the US dollar, which has been attempting to carve out something of a bottom since the beginning of July. It's had some pullbacks along the way, of course, but what we find is a series of higher highs and higher lows on the dollar index. This is a basket of major currencies against the US dollar, and because this basket was created before there was a euro, many of its legacy currencies are now the euro, and so in practical terms, this is basically just the euro exchange rate upside down. Nevertheless, it is showing signs that after this extended dollar decline since the very beginning of the year and into the mid-year point, that perhaps something is changing. And if in fact we get a CPI number that's a little bit warmer and these rate cut odds move even incrementally downward for September. So let's say we get from 86 maybe closer to 60. Still better than even odds of a cut, but just less convincingly so. Then one might expect a pullback on stocks. One might also expect an extension higher on the dollar, both as its yield advantage is reinforced against the other major currencies, but perhaps even more potently on risk aversion grounds. One of the biggest stories for the dollar and really the essence of this decline since the beginning of the year has been this idea that if you have the world's commercial currency facing a potent deglobalization push, well, then there's less trade and therefore less use for the currency. But if that part of the story is getting increasingly shelved as you get some clarity on these tariffs, a handful of trade deals, maybe a kicking of the can on the conversation between the U.S. and China when that deadline comes up, incidentally tomorrow, then perhaps those headwinds for the dollar have been spent. And we are now going to get back to a dollar that, because of its unrivaled liquidity, benefits at times of risk aversion, yields or no yields. And so perhaps we are looking at a turn in stocks. That's a difficult thing to bet on, if only because stocks don't like going down. But however this pans out, what you may have, absent a very robust risk-on response, perhaps, because rate cuts are coming, but they are not an emergency and they are not necessary to avert some sort of real disaster. Short of that, what you do have is perhaps a tradable bottom in the US dollar that's increasingly making itself known. And that is Macro Money for today. As ever, we are here right after Overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm likewise writing for the News and Insights portion of tastylive.com, commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.